Hi everyone. In this series of video lectures, we'll discuss the balance sheet and related financial disclosures. The balance sheet, sometimes referred to as the Statement of Financial Position, presents an organized list of assets, liabilities, and equity at a single point in time. It is a freeze frame or a snapshot of the company's financial position at the end of the last day in an accounting period. Shown here is an example of the asset section of the balance sheet of Nike. These classifications with related disclosure notes help the balance sheet to provide useful information to decision makers. The consolidated balance sheet is part of the annual report that public companies must file with the Securities and Exchange Commission, the SEC. The public can download the financial statements of public companies at the website www.sec.gov. Shown here are the remaining two portions of the balance sheet of Nike, the liabilities and shareholders' equity sections. An important aspect of the balance sheet is that total assets must equal total liabilities plus total shareholders' equity. In this case, $23,259,000,000 in total liabilities and shareholders' equity equals $23,259,000,000 of total assets for Nike. The balance sheet provides a list of assets and liabilities that are classified or grouped according to common characteristics. Liquidity often refers to the ability of a company to convert its assets to pay into cash to pay its current liabilities, while long-term solvency refers to an assessment of whether the company will be able to pay all of its liabilities, which include long-term liabilities as well. Other things being equal, the risk that a company will not be able to pay its debt increases as liabilities increase in relationship to equity. Solvency also provides information about the financial flexibility of a company. The financial flexibility refers to the company being able to alter cash flows in order to take advantage of unexpected investment opportunities and needs. For example, the higher the percentage of a company's liabilities in relationship to its equity, the more difficult it will typically be to borrow additional funds, either to take advantage of a promising investment opportunity or to meet an obligation. The company's book value is defined as the company's assets, shown on the balance sheet, minus the liabilities, shown on the balance sheet. However, the company's market value represents the price at which something could be sold in a given market. Despite its usefulness, the balance sheet does have some limitations. One important limitation is that the company's book value will usually not be equal to the company's market value. The two primary reasons that a company's book value in the balance sheet does not equal its market value are: 1. Many assets like land and buildings are measured at their historical cost rather than amounts for which these assets could be sold. The amounts at which these assets could be sold, by the way, is often referred to as the asset's fair value. For example, suppose a company owns land, and the amount for which the land could be sold increases. The increase in the land's fair value is not reported on the balance sheet, so it has no effect on the company's book value. However, to the extent the increase in the land's fair value is known by investors, that increase will be reflected in the company's overall market value. Number 2, many aspects of a company may represent valuable resources, such as trained employees, experienced management team, loyal customer relationships, and product knowledge. These items, however, are not recorded as assets in the balance sheet and therefore have a zero book value. Investors understand the ability of these resources to generate future profits, and therefore these resources will be reflected in the company's overall market value. Another limitation of the balance sheet is that many items in the balance sheet are heavily reliant on estimates and judgments rather than determinable amounts. Examples of estimates inherent in the numbers shown on the balance sheet include the amount of receivables management thinks they will be able to actually collect, the amount of estimated warranty costs they will eventually incur for products already sold, the residual values and useful lives of their long-term assets, and amounts used to calculate employee pension obligations. Each of these are estimates that will affect the reported amounts in the balance sheet. In summary, even though the balance sheet does not directly measure the market value of the entity, it does provide valuable information that can be used to help judge the market value. Well, that's all for this video. In the next video, we'll discuss the classification of elements within the balance sheet. See you next time.